Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Hello all. My name is Urevesh Desai, and I'm from the Macro Solutions Investment Boutique within Old Mutual. Joining me today is Wayne Sorour, who is part of Old Mutual International, and together we're going to be talking to you about investment principles that never change and offshore diversification. When I was asked to present, I was asked the question, what investing lessons never change? Now, I don't intend plugging a product or selling you a policy, but to answer this question, there are two bits of background I'll provide about the investment team which I represent, and that's Macro Solutions at Old Mutual. A few years back, as a team exercise, the Macro Solutions team went away and tried to come up with what our team's primary mission was. So we all went away and came up with what drives us personally, and then shared that with the rest of the team. We were actually pleasantly surprised that there was a large amount of consistency in what our mission was. And that can be summed up as winning with our investors. We all wanted to do well for the team and in our own capacities, but we also wanted investors in our funds to prosper, to save more and to get the most out of their savings. I tell you this because this was part of the thinking that actually drove us to come up with a publication called Long-Term Perspectives, which is the title you see here. As investors, Macro Solutions have always believed that history, viewed with in the appropriate light and with a correct perspective, has much to teach us. In fact, we have over time focused on history and gathered as much of it as we can in terms of data so that we can improve the perspective with which we view investing today. And because we have learned so much from history, we wanted to share this with our investors so they could learn too. And this is where long-term perspectives came about. It's an annual publication by Macro Solutions, which looks at returns of the major assets available to South African investors over a very long period, sometimes 100 years. And through the pages of the publication, we tease out what information and insight this has for investors today. So I thought it was extremely appropriate then to answer this question, what investing lessons never change, by talking to you about the lessons we've found in long-term perspectives. What we've learned by looking at that hundreds of years of data and the returns investors have experienced. You can read the colorful quote from Ronald Reagan here for yourself, but inflation is a key concept that any investor must have a grasp of. Inflation is the measure of how much the costs of goods and services are increasing, right? Why is this important? Well, the reason we save, perhaps not the only reason, but the primary reason is so that we can spend. And we spend on goods and services. Now, when we save, the aim is to pay for those goods and services in the future. And the one thing that we learn all the time, and actually the older you get, the better you know it, is that over time, the prices of things go up. So what we can buy today with 10,000 Rand is not the same as what we can buy in 10 years' time with that 10,000 Rand or 20 years from now. So the important concept, right, it's as the price of things go up, so too does the value of what you can buy with your money go down. So if we are investing for the future, to spend in the future, we need to make sure that our money is growing more than inflation. This is what is meant when people talk about growing in real terms. This is growth over and above inflation. Now, here's a good example of some of that data that we collect and look at. If you look at inflation in South Africa over the last 100 or 110 years displayed on the graph there, on average, it has been about 5.5%. There have been long periods where it has been above that and long periods where it has been lower than that. But on average, over this period, it's been about 5.5%. Now, here are the major asset classes available to a South African investor. You've got South African equities. These are companies listed on the Johannesburg Stock Exchange. You've got South African listed property referenced here. This is a subset of these companies that reflect the listed property sector. You've got South African bonds. This is largely South African government bonds, money borrowed by the South African government on which they pay interest regularly and eventually will repay the loan. And you've got South African cash. This is not just money in the bank, but actually other sorts of short-term fixed interest investments. Anything up to 12 months is the usual definition. Now, I want you to look at the second column here. This number shows you what the annualized return, so per year, has been over and above SA inflation for these various asset classes. For SA equities, you're looking at 7.7%, by far the highest for a South African asset. For SA property, it's only 2.2%, but I want to just clarify that that data, because of the limited data available on that, it's only from 1980. The rest of the data on the other asset classes actually goes back to 1930. If you look at South African bonds, they gave you 2% above inflation. If you look at South African cash, it gave you 1% above inflation. Now, this pattern is important and it's consistent over the long term. Equities give you higher long-term returns than bonds, which in turn give you higher long-term returns than cash. Now, if you look internationally, we see the same pattern. So just a note, if you look at the bottom there, these returns that we are now looking at are in a US dollar context. So we're looking at US dollar returns after adjusting for US inflation. If you look at international equities, these are equities listed everywhere in the world. So your Microsoft, Amazon, Taiwan Semiconductors, JP Morgan, Tencent, Johnson & Johnson, Alibaba, etc. Global bonds, these are global governments borrowing and paying back interest and the capital, as well as individual companies around the world. And then global cash, what we have here shown here is USD cash. And again, we have the same pattern. Equities, better long-term, giving you better long-term real returns than bonds, which are better than cash. In fact, if you look at cash on the international side, after you adjust for inflation, you've gone backwards on average. You've lost value in real terms. Now, you would think that with this information, the case was obvious for investing in equities. However, there is a drawback with investing in equities. From day to day, the price of a stock or a company's share can go up or down, and it can vary quite wildly over the very short term. Now, usually, any news that will affect a company's profits or that investors think may affect a company's profits will cause the price to fluctuate. While fluctuating up is a great thing, fluctuating down is a bad thing. And investors are terrified of losing money when these fluctuations happen. However, here's an interesting phenomenon when it comes to equity. The longer you remain invested, the lower your chance of losing money. The graph here shows, if we analyze the historical data, if you're invested for 1 day, right? So not quite practical, but if you're invested in equities for 1 day, 45% of the time, you will lose money. Now, that is extraordinarily high. It's almost as bad as a coin toss, 50-50. But look what happens as you stay invested. The chance of negative returns in equity goes down significantly. And in fact, once you get to 5 and 10 years of staying invested, there's almost no chance of getting a negative return. So the reason why people like cash over equities, because they don't want to lose money, that reason disappears completely when you remain invested for longer periods. Now, the analysis on the last slide was talking to returns in absolute or nominal terms, right? Rand for rand and no inflation adjustment. Here's the return, or the real return analysis. So it's the return after inflation on SA equity, on the SA equity market, and for each calendar year going back right to 1925. I want you to notice two things. There are a lot more calendar years on the right of the zero line. That means more often than not, equities are giving you returns over and above inflation. They're helping you maintain and grow the real value of your money over time. The second thing is when you're getting a big negative real return, this is usually during a major market crash or recession, right? You've got the years 2008 here, that's a great financial crisis, the 2000, the tech bubble bursting, 98, the Asian crisis, and 2020 was also here, right? It was also a major market correction.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.